Imagine waking up to find the world's most critical shipping lane just completely paralyzed. Like, global energy markets are in absolute chaos, and there's this hidden $2 trillion private debt crisis quietly bubbling to the surface.
Yeah, threatening to basically choke off capital to thousands of businesses.
Exactly. I mean, it sounds terrifying. It sounds like the exact moment you should, pull all your chips off the table and just hide.
Right, yeah.
But what if this exact moment of macroeconomic friction is actually your greatest opportunity to build and protect your wealth in 2026?
I mean, it's a highly contrarian thought, right? Because when the headlines are just dominated by, military conflict and supply chain collapses, human biology practically screams at us to panic.
Oh, absolutely. Freeze, liquidate everything, run for the hills.
Exactly. But if you look at the historical data, capital doesn't simply vanish during a crisis of this magnitude. It just radically and, violently relocates.
Spotting where that capital is flowing before the rest of the market catches on, that's the difference between being a victim of the macro environment and actually mastering it.
Which is really the core mission of this deep dive today. We are looking at the massive economic shocks radiating outward from the 2026 U.S., Israel, and Iran war. We're tracking the closure of the Strait of Hormuz, the resulting supply chain mutations, and a looming private credit crunch that the mainstream financial press seems to just entirely underestimate.
They're completely missing it, yeah.
Right. So to do this, we're synthesizing a massive stack of sources today. We've got geopolitical and economic impact reports from the Supply Chain Intelligence Institute Austria, the Complexity Science Hub, and Tomorrow's Affairs.
That's a lot of heavy data.
It is, yeah.
Okay.
And we're layering that with market analysis from Zacks Investment Research and Investing.com. And finally, we are anchoring our microstrategies with a really comprehensive 2026 digital wealth building guide from Bidget.
And, we really have to establish the parameters of our analysis right out of the gate here. Oh, for sure. Go ahead.
Because the source documents detail a major ongoing geopolitical conflict, right? Specifically, the U.S.-Israel military operations against Iran and the subsequent regional retaliations.
Right.
We are not political analysts.
Yeah.
And this deep dive takes absolutely no political sides. We are completely impartial.
Right, 100%. We are looking strictly at the mechanics of the global economy here. We're here to decode what the factual data in these reports means for your money, your portfolio, and your ability to build independent income streams.
Exactly.
So let's pull this apart, starting with the immediate geographic reality. The 2026 conflict has effectively blockaded the Strait of Hormuz.
Yeah.
Now, for someone who doesn't track maritime logistics for a living, why is this specific stretch of water between Oman and Iran causing such a disproportionate global panic?
Because it is, without a doubt, the ultimate bottleneck of the industrial world. I mean, it's arguably the single most critical maritime choke point on the planet. Just to, put this sheer volume in perspective, roughly 20% of the world's total global oil supply flows through that narrow gap every single day.
20%? That's wild.
Yeah, literally 1 in 5 barrels of oil consumed globally has to transit that specific waterway.
And the disruption detailed in our sources is staggering. The data indicates an immediate drop of somewhere between 6.7 to 10 million barrels per day from Gulf nations.
Just wiped right off the map.
Right. We're looking at sudden, massive export halts from Kuwait, Iraq, Saudi Arabia, the United Arab Emirates. And as a direct result, Brent crude immediately breached $100 a barrel.
Right.
With futures markets, pricing in surges past $120. But it's not just crude oil, right? The reports highlight that Qatar Energy had to declare force majeure on all their liquefied natural gas, or LNG, exports.
And that force majeure declaration is a massive signal.
How so?
Well, in contract law, that is the literal act of God clause. It's a legal mechanism a company triggers when circumstances are so catastrophic and far outside their control that they are physically and legally absolved from fulfilling their delivery contracts.
Wow.
Yeah. So when a supplier the size of Qatar Energy pulls that lever, it sends absolute shockwaves through the energy grids of Europe and Asia. I mean, they rely on that LNG to keep the lights on and factories running.
I really want to dig into how the analysts are actually forecasting the fallout of this, because the sources cite something called the TIDES model.
Okay.
Yeah, used by the Complexity Science Hub and the Supply Chain Intelligence Institute Austria. It stands for Trajectory Informed Discrete Event Simulation.
It's quite the mouthful.
It really is. It sounds like something out of a theoretical physics lab, honestly. How does this actually work in practice?
It's actually an incredibly sophisticated piece of data science. So instead of just looking at global shipping as a broad, fluid volume like X amount of oil moves per week,
Right.
discrete event simulation tracks individual specific actions in time. The researchers literally modeled 10,000 individual tankers as independent autonomous agents.
Wait, they modeled individual ships?
Yes, 10,000 of them. And then they mapped their movements and interactions across more than 1,300 global ports.
So they aren't just saying like, oh, 10% of oil is delayed. They are simulating tanker A leaves port B, arrives at port C at this exact minute, and requires this specific unloading crane.
Precisely. It's that granular.
Yeah.
And by running those simulations, they discovered a very specific threshold of pain for the global economy.
Okay, what is it?
The model revealed that a disruption of 14 days or less is actually manageable.
Really? 2 weeks is fine.
Yeah, surprisingly.
Hmm.
The global supply chain has enough, inventory buffers, floating storage, and slack at the destination ports to absorb a 2-week shock without structurally breaking.
I read that and I immediately thought of like a highway traffic jam, right?
Right.
If there's a 10-minute fender bender, the cars slow down, you get annoyed. But the highway clears up pretty fast once it's moved.
That is a really common way to think about it, but the tides model shows it's actually much, much worse than a traffic jam.
Oh, really?
Yeah. A better analogy is a highly synchronized automated factory assembly line.
Okay, walk me through that.
So if a piece of machinery on an assembly line stalls for 5 seconds, the line can catch up, right? But if it stalls for an hour, you don't just have a backlog of parts.
Right, the whole system backs up.
Exactly. The specific robotic arm waiting for that part sits idle. The workers downstream are standing around doing nothing. The delivery trucks waiting at the loading dock have to be rerouted.
Oh, and when the machine finally starts working again, you have this massive glut of product hitting an infrastructure that just, it isn't time to handle it all at once.
Yes, exactly. The model reviews that once the Hormuz disruption passes that 4-week mark, it creates cascading disproportionate delays.
And because ships are forced to reroute.
Right. They have to go all the way around the Cape of Good Hope at the southern tip of Africa. That adds weeks to their journey. It burns vastly more fuel.
Which is expensive.
Incredibly expensive. But here is the critical mechanism the model exposes. Because that ship took an extra 3 weeks to arrive, it completely misses its scheduled berthing slot at the port of Rotterdam.
Oh, wow.
Right. The specific crane reserved for it, given to someone else. The trucks waiting for its cargo, dispatched elsewhere.
Man.
And crucially, that ship is now unavailable for its next scheduled pickup back in Asia. The delays don't just add up, they multiply exponentially across the entire network.
Which fundamentally changes how we have to view this event, you know? If you're listening to this, you might be thinking, okay, a shipping lane thousands of miles away is closed. I'll pay an extra 40 cents a gallon at the gas pump for a month. I can live with that.
Yeah, people think it's just a pump price issue.
Right. But that is a complete misread of the situation. This translates directly into persistent structural inflation.
It changes the baseline cost of everything. I mean, we are already seeing the macroeconomic mechanism trigger in the reports. The European Central Bank, for instance, has officially postponed its planned interest rate cuts, specifically because of this crisis.
Wow.
Yeah. When energy prices soar, the cost to manufacture physical goods spikes. The cost to transport those goods around the Cape of Good Hope skyrockets, and those inflated costs are inevitably passed straight down the line to you, the consumer.
So central banks are forced to keep interest rates artificially high to cool down an inflation spike that wasn't even caused by consumer demand, right?
Right.
It's caused by a supply-side shock. And if rates stay higher for longer, that acts as an absolute wrecking ball for the broader business environment. Like, if the global supply chain is the gear that just jammed.
The second gear to violently strip its teeth is the corporate debt market.
Yes. This is the hidden threat we mentioned earlier, the $2 trillion private credit refinancing wall.
It's massive.
While the mainstream media cycle is just entirely consumed by the kinetic war in the Middle East, there is a massive financial reckoning happening in the background. To understand the mechanics of this, we really have to look back at the financial environment between, 2019 and 2021.
The era of completely free money.
Exactly.
Central banks had slashed interest rates to zero. Capital is practically free. And during that window, private equity firms and middle market companies, businesses doing maybe 50 to 500 million in revenue, they went on an unprecedented borrowing spree.
Just gorging on debt.
Gorging on it. They took out massive, highly leveraged loans to fund acquisitions, aggressive expansions, share buybacks, simply because the cost of carrying that debt was negligible.
But those weren't, 30-year fixed-rate mortgages like you or I would get for a house. These were shorter-term corporate facilities, usually like 3 to 5 year terms.
And that timeline brings us exactly right to 2026. The data from Tomorrow's Affairs highlights that over $150 billion in these middle-market loans are maturing and coming due right now.
Right now.
This is the refinancing wall. These companies, they cannot pay back the principal, so they have to roll the debt over into new loans.
But here is where the macro environment we just talked about becomes a literal trap. Because the Strait of Hormuz is causing an energy shock and inflation is super sticky, central banks have kept rates high.
Yep.
So these mid-market companies aren't refinancing at their old, 3 or 4% rates.
Not even close. They're looking at refinancing at rates that are often 8, 9, or even 10%. Their cost of capital is essentially doubled, and in some cases tripled.
That's insane.
Imagine if the monthly payment on your house suddenly doubled overnight, but your salary stayed exactly the same. The strain on corporate balance sheets is immense.
And the cracks are already highly visible, right? Like the credit rating agency Fitch reported that the default rate for the U.S. private credit portfolio has hit a record 9.2% for 2025. That's up from 8.1% the year before.
It's a huge jump.
Wait, okay, I have to push back on that 9.2% figure for a second.
Sure.
Because it sounds terrifying on the surface, but aren't we just seeing a return to the historical mean? Like, we had a decade of 0% interest rates that artificially propped up a lot of bad businesses. Isn't a higher default rate just the market naturally pruning the deadwood? Why are the analysts suggesting this time is going to cause a catastrophic shock?
That is a phenomenal question. And, you are right that some pruning is completely natural. But the analysts point out that the sheer volume of debt, combined with the sudden velocity of the rate hikes, creates a really unique systemic risk here.
Okay.
Furthermore, the sources emphasize that this isn't going to look like the 2008 financial crisis.
We're not getting a Lehman Brothers moment.
Exactly.
Yeah.
We aren't going to see massive banks collapsing overnight, triggering a sudden catastrophic banking crash. The major banks are heavily capitalized now.
So what's the real danger then?
The real danger is what Daniel Lacalle in Tomorrow's Affairs defines as a slow credit crunch.
A slow credit crunch. Walk us through the mechanism of that. What does that actually look like for a business operating on the ground?
It basically operates through risk aversion. As defaults tick up that 9.2% mark, lenders, so banks and private credit funds, they become hyper-defensive.
Right, they want to protect their money.
Exactly. To protect their balance sheets from further losses, they dramatically tighten their lending standards. They demand punitive interest rates, they require much stricter covenants, or they simply refuse to extend credit to small and medium-sized businesses altogether.
Wow.
The spigot of capital is just slowly and quietly turned off.
And without access to that liquidity, businesses can't invest in new technology, they can't expand their facilities, they certainly can't afford to hire new talent, right?
Nope. Which leads to the economic phenomenon of business zombification.
Zombification, that is a grim term.
It's grim, but highly accurate. A zombie company is a business that is generating just enough revenue to service the crushing interest payments on its debt, but it has absolutely zero capital left over for growth.
So it's effectively dead in the water.
Completely.
Yeah.
It can't innovate. It's just shuffling along, slowly decaying, literally one missed payment or a supply chain shock away from bankruptcy.
And if you are listening to this deep dive, this is exactly where the macro hits your micro reality. If traditional corporate credit dries up and we see widespread zombification across the middle market, W-2 jobs become inherently unstable.
Highly unstable.
Right. Relying solely on a traditional corporate paycheck in a constricting credit environment is a massive vulnerability. You're basically outsourcing your financial security to a system that is actively deleveraging. You cannot just ride this out in a target date retirement fund.
No, you can't, which necessitates a radical shift in how we approach our wealth. If the domestic U.S. market is bogged down by zombie companies, tech volatility, and the anxiety of geopolitical events, relying entirely on domestic equities is a severe risk.
It's putting all your eggs in a very fragile basket.
Right. And the Wealthnetic philosophy is rooted in proactive diversification. The data from Zacks Investment Research points clearly toward overseas markets offering a really vital hedge right now.
Let's actually look at the numbers on that. The
Yeah.
MSCI EAFE index, which, for anyone unfamiliar, tracks mid and large cap stocks in developed countries outside of the US and Canada. So places like Europe, Australasia, the Far East.
Right.
That index recently delivered a staggering return of 30.48%. I mean, that vastly outperformed our domestic indices. If US companies are choking on debt, capital is fleeing the blast radius to find yield.
Exactly. And Zacks highlighted 3 highly specific plays for 2026 to build a resilient, anti-fragile portfolio.
Let's hear them.
The first one is Kinross Gold, ticker KGC.
Okay, now gold is the classic, almost cliche safe haven during war and inflation. But why specifically a gold miner like Kinross, rather than just, buying an ETF that tracks physical gold bullion?
It all comes down to the underlying mechanism of cash flow.
Okay.
Physical gold produces no yield, right? It just sits in a vault, acting as a store of value. You hope the price goes up.
Right.
But a mining company like Kinross, which operates diverse projects across the Americas and Africa, provides massive leverage to the price of gold.
How does that leverage work?
So as the price of gold surges due to all these macro fears, Kinross's cost to actually pull an ounce out of the ground remains relatively fixed.
Yeah.
They already own the equipment, the land, the labor contracts.
So their profit margins just explode.
Exactly. Zacks notes their soaring cash flows and really strong shareholder returns. They're actually projecting an expected earnings growth of over 147% for 2025. They're actively producing and returning value in a high inflation environment rather than just acting as a static rock in a vault.
That makes total sense. Now, the second play Zacks highlighted is a pivot toward digital resilience, which is Sony Group, ticker SONY.
Yeah.
Now, at first glance, a Japanese electronics manufacturer seems like a terrible play when global shipping lanes are literally shutting down. I mean, how are they getting PlayStations across the ocean?
Well, that is the brilliance of their current structural pivot.
Okay.
Sony is executing an entertainment-led strategy. They are aggressively moving away from relying purely on the physical supply chain of hardware.
Oh, interesting.
Yeah, they're pivoting towards services, software, and active user ecosystems. Even if a container ship full of physical consoles is delayed off the Cape of Good Hope for a month,
Right.
the digital entertainment, the PlayStation Network subscriptions, the digital game downloads, their whole media ecosystem, it continues to generate massive high-margin revenue instantly.
Because digital goods don't get stuck in maritime traffic jams.
Exactly. It's a
Okay.
complete bypass of the physical bottleneck.
That's incredibly smart. And the third company Zacks highlighted is fascinating, especially given our discussion on the credit crunch. They highlighted HSBC, a major global bank.
Yes.
Why on earth would we want a bank right now with all the debt walls?
Because of geographic arbitrage.
Okay, explain that.
So HSBC is headquartered in London, but they have clearly recognized the stagnation in Western markets. They see the refinancing wall coming.
Right.
So they are actively executing a strategic exit from non-core operations in the US and Europe. They are getting out.
Wow. Where are they going?
Instead of fighting the current in the West, they are doubling down on wealth management in Asia and the Middle East.
Right.
The source data shows they recently brought in $29 billion in net new invested assets, and $15 billion of that came directly from the Asian markets.
Wow, they are ruthlessly moving their chips to where the capital growth is actually happening, just completely avoiding the Western debt refinancing wall entirely.
Precisely. And there's a secondary mechanism at play here for the U.S. investor. Currency hedging. Holding these foreign stocks, like Sony or HSBC, means holding assets denominated in foreign currencies.
Right, which acts as a crucial structural hedge.
Exactly.
Yeah.
If the U.S. dollar weakens due to domestic economic strain, or if the Fed is forced to monetize government debt to keep things afloat, those foreign assets retain their value in real terms.
It's an essential layer of armor for your purchasing power.
It really is.
But, playing the international equity markets is still playing defense. It's protecting what you have. To truly thrive in the Wealthnetic model during a period of sticky inflation and credit contraction, you cannot just invest. You have to aggressively out-earn the inflation.
Yeah.
You need scalable, active income. And this really brings us to the profound shift detailed in the 2026 Big Digital Wealth Building Guide.
Yeah, we've established that the traditional corporate ladder is structurally compromised right now. The absolute best antidote is scalable digital income.
Right. And the landscape of the freelance economy has just entirely mutated in the last 2 years. We aren't talking about writing SEO blog posts for a penny a word or, doing basic graphic design on Fiverr.
Far from it. The highest earners in the 2026 economy have positioned themselves directly at the intersection of artificial intelligence and business operations.
The Big Dick Guide specifically highlights roles like AI prompt engineers, automation consultants, and digital transformation specialists commanding anywhere from $100 to $250 per hour.
Yeah, the rates are incredible.
Now, I want to demystify this for the listener because AI prompt engineer kind of sounds like you just type a question into ChatGPT and get paid.
Right. It's not that simple.
Right. So how are these people actually generating that kind of hourly rate? What is the actual mechanism of their value?
The value completely comes from structural implementation, not just casual usage.
Give me an example.
Sure. An AI automation consultant doesn't just ask a large language model a question. They audit a business's entire workflow. Let's say they approach a mid-market logistics company, right? One that is drowning in supply chain chaos from the Hormuz closure.
Okay, so they're stressed out.
Highly stressed. And this company has, say, 5 employees spending 40 hours a week manually reading inbound emails from suppliers, figuring out delays, and updating spreadsheets.
Which is a huge drag on payroll.
Exactly. The consultant comes in, uses AI tools, API integrations, and custom logic to build an automated pipeline. This pipeline reads those inbound emails, extracts the relevant data, automatically updates the company's CRM, and instantly drafts status replies.
And so they just eliminated, 200 hours of manual labor a week for that company?
Yes. And when you can prove to a business owner that your digital system will save them tens of thousands of dollars in payroll and operational drag, they do not care if you charge them $150 or $250 an hour.
It's a no-brainer.
The return on investment is undeniable. You're buying them time and efficiency when they need it most.
And the most empowering aspect of this shift, I think, is the complete destruction of traditional barriers to entry.
Oh, absolutely.
The corporate world is shedding its obsession with 4-year degrees. They are desperate for operational efficiency. If you can build a digital portfolio like a GitHub repository, a live website, or a simple case study video that proves you can deploy these AI models to solve real business bottlenecks, you will get hired.
100%. In 2026, a portfolio of verifiable results is worth infinitely more than a traditional paper resume.
It is a pure, brutal meritocracy. But, generating that active, high-margin digital income is only phase 1.
Phase 2 is protecting it.
Right, protecting it from the erosive force of inflation and systemic fiat debasement. As inflation runs hot, leaving that newly earned capital in a standard bank account yielding 1%, that's mathematical suicide.
It guarantees a loss of purchasing power over time.
Which is exactly why the Big Dick Guide emphasizes the integration of digital assets and cryptocurrency into an anti-fragile portfolio. Now, the crypto space can be incredibly intimidating for a traditional investor.
It's definitely overwhelming for beginners.
For sure. But the guide points to Bidget as a prime on-ramp because it balances an enormous roster of assets. We're talking over 1,300 digital tokens with critical infrastructure like ultra-low 0.01% spot trading fees.
And we should explain why that specific fee structure matters so much over a multi-year time horizon.
Yeah, please do.
In compounding investment environments, fees are friction. If you are actively trading or, say, dollar cost averaging into digital assets on a platform that charges a 1% or 1.5% spread on every transaction, you are structurally handicapping your returns.
It doesn't seem like much at first, but it adds up.
It adds up massively. Over 5 years, that drag consumes a massive percentage of your alpha. A 0.01% spot fee ensures that your capital is actually going into the asset, not the exchange's pocket.
Right. But fee structures don't really matter if the exchange collapses, right? Post-2022, security is the only metric that truly matters.
Absolutely. Which is why the guide highlights BitGet's $300 million protection fund and their cryptographic proof of reserves.
Okay, what is proof of reserves for someone who isn't familiar?
It's a mechanism where the exchange uses Merkle trees, which is a specific type of cryptographic data structure, to mathematically prove on the blockchain that they hold client assets one-to-one.
So they can't lend out your money behind your back.
Exactly. It prevents the fractional reserve lending disasters we saw with platforms like FTX. You can independently verify that your assets are actually there sitting in the vault.
That structural transparency is paramount right now. But honestly, the feature in the guide that I found most practical for the Wealthnetic listener, especially someone who is just stepping into this space, is the one-click copy trading.
Oh, it completely flattens the learning curve.
How does it actually work?
So instead of trying to read technical charts, understand moving averages, and guess market movements, the copy trading mechanism allows you to automatically mirror the real-time trades of vetted, highly profitable veteran investors.
Wow.
Yeah. You allocate a portion of your portfolio, and when the expert executes a trade, your account proportionally executes the exact same trade.
That's incredible. So you get to leverage their years of market intuition while you learn the mechanics of the space safely.
Exactly. It's the ultimate bridge between traditional finance and decentralized wealth.
It really is. Now, I want to pivot from the theoretical frameworks and look at some highly specific real-world case studies from our sources today.
Let's do it.
Because this is where we see the macro chaos translate into on-the-ground micro opportunities. The first story is from the demographic data regarding the Indian returnees. I found this absolutely fascinating because it perfectly illustrates the concept that capital doesn't disappear, it just relocates.
Demographic shifts are always the clearest indicator of future localized economic booms. Always.
Right.
Because of the geopolitical instability in the Gulf and the blockade of the Strait of Hormuz, the data shows that over 220,000 Indian expatriates have repatriated back to India from the Middle East.
And we really need to clarify who these people are, right? We're not just talking about temporary manual laborers.
No, not at all. A massive percentage of these returnees are highly skilled professionals. Senior executives, engineers, business owners who have spent decades building real wealth in places like Dubai or Doha.
So they are returning to their home country carrying significant liquid capital and high-level global business acumen.
Yes. But the real insight, the actionable insight, is in tracking where they are deploying that capital upon their return.
Right, because the natural assumption is that this influx of high net worth individuals would just flood straight back into the massive overcongested Tier 1 megacities, Mumbai, New Delhi.
But the data shows they are actively avoiding those saturated markets.
Which is so interesting.
Instead, they are taking their capital, their families, and their businesses to Tier 2 and Tier 3 cities across India, places with better air quality, a lower cost of living, and far less congestion.
Because modern digital infrastructure allows them to manage their wealth remotely anyway.
Exactly. And the economic ripple effect of that specific decision is profound. The real estate data from the sources indicates that this localized influx of reverse migration capital has sparked a massive 14% growth in these secondary real estate markets.
Think about that. A 14% real estate boom occurring right in the middle of a paralyzing global macroeconomic crisis.
It perfectly illustrates a fundamental Wealthnetic lesson. Macro chaos creates micro booms.
Yes.
If you're only watching the mainstream headlines, you see the devastation of the shipping lanes and you assume the entire global economy is collapsing.
Right, you just hide your money under the mattress.
But an observant investor, tracking the flow of human talent and capital, spots a localized, explosive economic boom happening in secondary Indian cities. Wealth is built by finding the signal in the noise.
That is an incredibly powerful framework. Now let's look at the second case study from our sources, which is, well, it's a bit more sobering, but it's absolutely essential to understand if you want to protect your purchasing power. It involves the butterfly effect of fertilizer and global food prices.
Yeah, this one is critical. When the average person hears that the Strait of Hormuz is blocked, they immediately think of crude oil and gas prices.
Of course. My commute is going to be more expensive.
Right. But the commodity reality of that region is vastly more complex.
The reports reveal a statistic that completely changes the paradigm, honestly. The Gulf region accounts for roughly 45% of the world's global supply of sulfur, alongside massive critical exports of urea.
Both of those elements are the invisible bedrock of the global agricultural sector.
How so?
Well, sulfur is refined to produce sulfuric acid, which is the fundamental chemical component required to manufacture phosphate fertilizers.
Okay.
And urea is the world's most common and essential nitrogen fertilizer. Without them, modern high-yield farming just collapses.
So when the strait is blockaded, we aren't just starving the global economy of energy, we are literally starving the agricultural sector of the raw nutrients required to grow food.
It's a terrifying thought. Now, the agricultural analysts point out a crucial nuance here. This blockade won't necessarily destroy immediate crop yields this season.
Okay, that's somewhat good news. Why not?
Because large-scale farming operations and national reserves, they have buffer stocks of fertilizer to get through the short term. But the mechanism of inflation triggers at the profitability level.
Right.
As the global supply of sulfur and urea plummets, the cost of fertilizer on the open market skyrockets. Farmers suddenly have to pay drastically more to grow the exact same yield of crops.
And farmers operate on razor-thin margins as it is. They cannot just absorb a 40% increase in input costs out of the goodness of their hearts.
No, they go bankrupt.
They are forced to pass that cost directly down the supply chain to the food processors, the distributors, and ultimately straight to the grocery store.
Exactly. This dynamic drives up long-term, structural global food prices. It creates a scenario that deeply echoes the brutal global food inflation crisis we saw back in 2022.
And this case study right here is exactly why we keep hammering home the reality that inflation in 2026 is sticky.
Very sticky.
It isn't a temporary phenomenon caused by consumer spending. It is a structural supply shock. When a physical stretch of water closes in the Middle East, the cost of a loaf of bread, a carton of eggs, a gallon of milk, it goes up at your local grocery store 6 months later.
It is all mechanistically connected.
It is, and it reinforces the undeniable reality. You cannot clip coupons and save your way out of a structural global supply shock. Frugality will not save you. You must aggressively expand your earning power.
Which serves as the perfect transition into our Wealthnetic actionable takeaways.
Let's get into it.
We've diagnosed the massive macro environment. Now we really need to execute on the micro level. How does the listener actually build an anti-fragile financial fortress today?
Let's get right into the execution. Takeaway number 1. Implement a barbell strategy for your investments.
Right. The barbell concept is about avoiding the dangerous, mushy middle of the risk spectrum.
Like what?
Things like corporate bonds from those zombie mid-market companies we talked about earlier.
Oh, right. Stay away from those.
Exactly. Instead, you put your capital weight heavily on the two extreme ends of the spectrum. On one end, you anchor your portfolio with hyper-safe traditional assets.
So, using established brokerages like Fidelity or Robinhood to hold fee-free broad market index funds, or those high cash flow dividend-paying overseas stocks like Kinross Gold.
Yes. This is your bedrock. It's safe. It's reliable.
And what goes on the hyper-aggressive end of the barbell?
That is where you allocate a smaller, highly calculated percentage of your portfolio to cutting-edge digital assets and asymmetric growth opportunities.
Like using platforms like BitGet to take positions in the crypto space.
Exactly. Using their one-click copy trading to mitigate your blind spots while seeking high alpha returns.
So you let the small portion of your portfolio hunt for massive upside in the digital economy, while the vast majority of your wealth is protected in stable traditional markets.
It mathematically balances your risk profile.
It gives you the upside of the chaos without exposing your foundation. I love it. Takeaway number 2. Monetize artificial intelligence for active income.
Yes. Stop treating AI like a parlor trick and start using it as a serious consulting tool.
There is a massive difference between asking an LLM to generate a funny poem and using it to audit and automate a small business's customer acquisition pipeline.
Huge difference.
This is literally the most actionable step you can take today. Reach out to a local business like a plumber, a real estate agency, an accounting firm. Find out where their workflow is bottlenecking.
Ask them what takes up the most manual time.
Right. Then build a custom GPT or an automated integration that solves that specific bottleneck. Do it for free the first time to build your case study.
That's the key. Build the proof.
Then use that verifiable result as your digital portfolio to pitch the next 10 businesses. Show them you can cut their overhead, and they will gladly pay you consultant rates.
Which directly powers takeaway number 3.
Which is
treat your active side income strictly as seed capital.
Yeah.
We need to talk about the velocity of money here.
Yes. The math on this is incredibly motivating. If you can generate just an extra $27.40 a day online, whether that's from a specialized freelance AI gig, selling a digital template on Gumroad, or running a paid Substack that translates to roughly $10,000 a year in gross revenue.
10 grand.
But the Wealthnetic rule is absolute. You do not use that $10,000 to finance a new car lease or inflate your lifestyle.
No. The moment you spend that active income on depreciating consumer goods, you kill the compounding engine.
Right.
You must treat that $10,000 as seed capital. You take that active income and instantly reinvest it.
You deploy it into those overseas dividend stocks.
You put it into high-yield staking protocols on BitGet. You use it to fund the advertising budget for your next digital product.
You are aggressively converting active labor into assets that generate passive, recurring revenue.
That mechanism is how true wealth escapes the gravitational pull of inflation.
You build a machine that prints money while you sleep. And finally, takeaway number 4. Practice ruthless, unsexy risk management.
In a highly volatile macroeconomic environment like 2026, Defense wins championships. The best defensive portfolio in the world will just collapse if the structural foundation is weak.
We are talking about the absolute basics that save you from total disaster. If you are generating freelance consulting income, track every single dollar of your 1099 NEC revenue so you aren't financially gutted by the IRS at tax time.
Get an accountant if you have to.
Set up a proper LLC to shield your personal assets from business liability. Implement hardware-based multi-factor authentication on every single exchange account and financial app you use.
MFA is non-negotiable.
And the unbreakable golden rule of the barbell strategy. Never, under any circumstances, invest capital into the volatile end of the spectrum that you need to pay your rent next month.
If you mathematically protect your downside risk, the upside growth will eventually take care of itself.
All right, let's pull all of these threads together as we wrap up. We are navigating a period of immense, historic, macroeconomic friction.
Unprecedented.
We have paralyzed shipping lanes in the Strait of Hormuz, acting as a structural catalyst for global energy and food inflation. We have a silent $2 trillion private debt refinancing wall threatening to choke the life out of traditional corporate credit markets and W-2 stability.
The old, reliable systems of the 2010s are showing deep, irreparable structural fractures. You just cannot rely on the old playbook anymore.
But as we have mapped out today, chaos is simply the reallocation of capital. By strategically diversifying your portfolio into resilient international equities, barbelling your traditional and digital assets, and relentlessly building high-margin, AI-driven digital income streams, you can build an anti-fragile financial fortress.
You can thrive regardless of how terrifying the macro headlines become.
It is entirely about choosing to be proactive rather than being a reactive victim of the macro environment.
That is the ultimate takeaway.
If you found actionable value in this deep dive, please hit that subscribe button on the Wealthnetic channel. We are continuously breaking down the deep-level strategies you need to stay ahead of this shifting economic curve.
And please, take a second to share this deep dive with a friend, a business partner, or a family member who needs a clear, tactical, financial roadmap for 2026.
Yes, share it. We all need to be navigating this volatility together. Any final thoughts to leave us with?
Yeah, if we connect all of these geopolitical and economic threads to the truly big picture, as the traditional global supply chains and fiat currencies continue to fracture under the massive weight of kinetic war and private debt, we have to seriously ask ourselves a foundational question.
What's that?
Over the next decade, will the ultimate safe haven for human capital be a physical piece of land governed by a central bank? Or will it be a fully decentralized, borderless digital economy that no single nation-state can ever blockade?
Wow.
It is a profound paradigm shift to consider as you architect your portfolio for the future.